He'd been driving for Uber at night, saving $5,000 while finishing college. And when we sat down together, he asked me a question that felt as old as capitalism itself. Is it even worth investing such a small amount? I looked him straight in the eye and said, "Son, that $5,000 is worth more than my first billion." He laughed, thinking I was being kind or poetic. I wasn't. I was being ruthlessly literal. That little pile of cash in his account held advantages my billions can no longer buy. The real paradox of investing is that small money beats big money. Not in absolute size, of course, but in potential return. The smaller your capital, the larger the field of hidden opportunities that opens beneath your feet. You can slip through cracks in the market that giants like me can't even kneel down to see. The tragedy is that almost no one tells young investors this truth, because the entire finance industry depends on them believing the opposite. The world of money runs on scale, and scale demands fees. A brokerage can't make a living managing your $5,000, so they quietly teach you to believe it's too small to matter. They sell you the illusion that wealth begins only after a certain number of zeros. That's nonsense. Wealth begins the moment you start learning how to think rationally about the few dollars you already have. When I told that young man his small stake was priceless, I wasn't talking about motivation or hope. I was talking about mathematics, the mathematics of being small. With limited capital, you can go where large institutions can't follow. Tiny mispriced businesses, forgotten real estate corners, local deals that never appear on a Bloomberg terminal. These pockets of inefficiency are like wild berries growing just beyond the reach of billion-dollar hands. The irony is painful. As investors get richer, they become too large to stay smart. The system forces them upward into markets that are perfectly efficient, perfectly analyzed, and perfectly mediocre. They trade liquidity for creativity, and by the time they realize what they've lost, it's gone forever. I told the kid, "You have something I would pay $100 million to have again, the right size. You can still be nimble, invisible, underestimated. You can still make the kind of intelligent, concentrated bets that turn learning into compounding." He started to tear up, not because he was emotional, but because he suddenly saw that his so-called disadvantage was the rarest advantage of all. In the next few minutes, I'm going to explain exactly what I told him. The three principles that allowed me to earn 50% annual returns when my capital was small, and why those same moves become mathematically impossible once you get too big. This isn't a motivational speech. I'm too old for that. This is arithmetic. And arithmetic, unlike opinions, doesn't care who you are. So before you envy the billionaires, understand this. Their size is their cage, and your smallness is your freedom. Let me tell you about the phone call I received at 2 in the morning in 1963 that changed everything I thought I knew about investing. It was 1963, and the phone rang at 2 in the morning. I still remember the sound, the hollow clatter of an old rotary phone echoing through a quiet house. I had been asleep, the kind of deep sleep that comes only after a long day of work and reading, but the moment I heard that ring, something in me stirred. It was Al Marshall. Al was a businessman I'd met at a charity golf tournament the year before. A good man, bright and restless, always chasing something more interesting than whatever he was currently doing. That night, though, his voice was different. He was shaking, breathless, almost childlike in his excitement. He said, "Charlie, I couldn't sleep. I had to call you. I just ran the numbers on our oil royalty investment, the little one we put $1,000 into. You're not going to believe this." I sat up, rubbing my eyes, trying to pull myself awake. "Calm down, Al," I said. "What are you talking about?" He laughed, or maybe gasped. It was hard to tell which. "Charlie, it's going to pay $40,000 in the next 12 months. $40,000 from a $1,000 investment." For a moment, I didn't say anything. I thought he was exaggerating, maybe misreading a report. But then I realized he had done the math correctly. The wells had hit. The royalties were real. We had turned $1,000 into $40,000 in cash flow, not valuation, not potential. Cash. Al was almost trembling. "I've worked 60-hour weeks my entire life to make $40,000 a year. We just made it from $1,000 in some legal paperwork in 18 months. I can't stop shaking." I told him, "Go back to sleep, Al. Enjoy it. You earned it." But the truth is, I didn't sleep either. Not that night. Not because of the money. The money was nice, but I had made and lost small sums before. What kept me awake was the realization that I had just stumbled onto something that broke the normal rules of scale. That little deal was my first real encounter with the mathematics of being small. $1,000 deployed intelligently in a space too tiny for the giants to enter could achieve results that were literally impossible at a larger scale. Here's the part that still amazes me when I think back, that one investment didn't stop at $40,000 in the first year. The royalties kept flowing. 60 years later, those wells still pay me about $70,000 every single year. Not $70,000 total, $70,000 per year. If you add it up, the total return from that single $1,000 bet has crossed $1 million. 1,000 turned into $1 million, not through trading, not through luck, but through a combination of legal structure, patience, and the inherent inefficiency of small opportunities. Now, before you start romanticizing it, let me be brutally honest. Deals like that are rare. You don't find them by accident, and not every little opportunity turns into a golden goose. There's a reality you need to respect. Of course, not every deal works like that. But the pattern was universal. Small, illiquid, legally structured deals that big money could never touch. This wasn't about oil. It was about size, structure, and the simple arithmetic of scale. See, back then, I wasn't rich. I was just another hungry young man trying to find a way to multiply limited capital. And because my capital was small, I could move into corners of the market that were invisible to the institutions, places that were inefficient precisely because they were ignored. The oil royalty deal was one of those corners. It existed because a few landowners wanted to sell their future royalty streams for quick cash, and no large firm could be bothered to structure a deal that small. The paperwork alone wasn't worth their time. That phrase, worth their time, has probably killed more opportunities than any bad idea ever could. But for me and Al, it was worth everything. We were small enough to notice it, small enough to act fast, and small enough to care. After that first year, we reinvested the profits, not by scaling up to some big operation, but by repeating the same logic. Find the next inefficiency, the next neglected corner, the next forgotten pocket of value. Each one was like finding an unguarded orchard while everyone else was busy chasing the same overfarmed land. Over the years, that little oil deal became a constant reminder, a kind of living proof, that scale is both a blessing and a curse. When you're small, you can make decisions that move the needle. You can find asymmetric bets, situations where the upside is vast and the downside is tolerable. But once you grow large enough, those same opportunities disappear, not because they vanish from the world, but because they vanish from your feasible universe. When you manage billions, a $1,000 deal becomes an annoyance, not an opportunity. Even a $10 million deal doesn't matter when it can't move the total portfolio by more than a rounding error. I've reached a point in my life where my own success has priced me out of the very investments that made me successful. And that's the cruel paradox. Success slowly closes the door that smallness once opened. That oil royalty investment taught me more than any finance textbook could. It taught me that the greatest inefficiencies in the world aren't hidden behind algorithms or secret formulas. They're hiding in plain sight, in the cracks too narrow for the big players to squeeze through. It taught me that the relationship between capital and opportunity isn't linear, it's inverted. The smaller the capital, the wider the field of truly extraordinary opportunities. People like to talk about the power of compounding, and they're right. Compounding is miraculous, but what they forget is that compounding isn't just about time. It's about starting from a position where your decisions actually matter. When you're small, one smart choice can double your wealth. When you're managing 100 billion, even genius barely nudges the needle. That night in 1963, as I lay awake, I realized that wealth isn't just a function of intelligence. It's a function of scale. Too small, and you can't survive the volatility. Too big, and you suffocate under your own weight. Somewhere between those extremes lies the perfect size. The sweet spot where rational thinking meets meaningful opportunity. The world will tell you that small investors are at a disadvantage, that you can't compete with hedge funds or institutions or billionaires. They're wrong. The truth is, those giants would trade places with you if they could, just to have the freedom of smallness again, the ability to move quickly, to buy into obscure, inefficient corners, to act without a committee or compliance department breathing down their neck. I've lived long enough to see that truth play out over and over again. The great fortunes, mine, Buffett's, so many others, didn't start with scale. They started with a small pile of capital and an even smaller circle of competence, where the playing field was tilted in our favor, precisely because nobody else wanted to play there. That's what that phone call from Al Marshall really meant. It wasn't just the sound of a man discovering wealth. It was the sound of two small investors discovering freedom. The kind of freedom that vanishes the moment you become too big to be nimble. I still get checks from that oil deal. They arrive quietly, the way old lessons do. Each one reminds me of the most ironic truth in investing. The more money you have, the fewer great opportunities you'll ever see again. I can never make that investment again. Not because it was unique, but because I've become too large for it to matter. I have, quite literally, been priced out of the best investment of my life by my own success. You see, there's a conspiracy of silence in the finance industry. A quiet, well-polished lie that almost every broker, banker, and advisor repeats without even realizing it's a lie. They tell you that your small amount of money isn't enough to matter, that you should wait until you have $10,000, $50,000, maybe $100,000 before you start investing. They say it with a sympathetic tone, as if they're doing you a favor by keeping you safe. The truth is simpler and much uglier. They don't make enough money off your $5,000 to care about you. Their entire business model runs on fees, and fees require scale. $1 million account makes them a few thousand in annual management charges. Your $5,000 makes them a cup of coffee. So, instead of admitting that, they redefine reality for you. They plant the idea that small money is powerless, and that real investing begins only when you're rich enough to pay them. That's the first part of the conspiracy. The second part is even worse. They genuinely don't know how to invest small amounts profitably. The system has trained them to think in institutional scale. Fund structures, quarterly benchmarks, liquidity constraints. Every spreadsheet, every algorithm, every risk model they use assumes capital measured in millions or billions. They've forgotten that the world looks completely different when you're dealing in thousands. If you gave the average fund manager $10,000 and told him to double it, he'd have no idea where to start. The machine he operates can't even move in that small A space. But if you gave that same task to a thoughtful small investor who's willing to read, dig, and act locally, he could find dozens of places where the math works beautifully. That's the great irony. The places where small investors can thrive are precisely the places big investors can't reach. Small capital is not a weakness, it's a unique kind of mobility. When I was young, that was obvious to me. But over the decades, as the industry professionalized and scaled, it became invisible. People started believing that more money meant more intelligence, when in fact, more money usually just means more constraints. Let me explain that constraint clearly, because it's the single biggest misunderstanding in modern investing. Berkshire Hathaway, the company Warren and I have spent our lives building, now manages hundreds of billions of dollars. That scale sounds magnificent, and it is in many ways, but it comes with a quiet mathematical curse. For any investment to move the needle for Berkshire, it has to be able to absorb at least $3 billion of capital. $3 billion. That's not a typo. It means that if we find a perfect little company worth only 20 or 30 million, something that could double or triple over a few years, it's completely useless to us. Even if we bought the entire business, it wouldn't change Berkshire's portfolio by 0.1%. We literally can't care about it. And that simple arithmetic eliminates 99. 9% of all opportunities on Earth. Every micro-cap stock, every small private company, every local real estate deal, every distressed asset in a small town, gone, off the table. The doors that used to swing wide open when we were managing small pools of money are now welded shut by our own success. That's the price of scale. The bigger you get, the smaller your world becomes. Let me paint you a picture. Imagine a small manufacturing company in rural Pennsylvania that makes precision parts for farm equipment. The founder is 70 years old, wants to retire, and has no children interested in taking over. The company is debt-free, makes $300,000 a year in profit, and the whole operation could be bought for around $2 million. 7 times earnings. For a small investor with $50,000, that's an extraordinary opportunity. You could buy a meaningful stake, help the owner transition, maybe modernize the marketing, and earn steady returns for decades. It's the kind of business that quietly compounds wealth while everyone else is chasing excitement. But for Berkshire Hathaway, or any large institutional fund, this deal is meaningless. We can't even send an analyst to visit because the potential profit is smaller than our travel budget. That's how absurd the scale problem becomes. The very best opportunities in the world, real cash-producing, mispriced assets, are sitting untouched simply because they're too small to matter to the giants. Now imagine multiplying that Pennsylvania company by the thousands. Thousands of local businesses, small properties, niche manufacturers, and specialized services around the world. Each one a potential fortune for someone small enough to care. Together they form what I call the small investors universe. It's a vast hidden ecosystem full of inefficiencies and asymmetries, a parallel world that big money can't physically enter. And yet, most small investors never step into it. Instead, they imitate the portfolios of billionaires, buying a few shares of Apple or Coca-Cola or American Express, thinking they're investing like Warren Buffett. That's completely backward. You shouldn't be copying what we own now. You should be studying what we did when we were your size. When Warren was running his early partnerships in the 1950s, he wasn't buying global brands. He was buying obscure little companies, trading below the value of their cash. He was buying cigar-butt businesses, ugly, forgotten, mismanaged, but cheap enough to offer one last profitable puff. He was investing in situations so small that even the local newspaper didn't care. Those were the kinds of bets that built his fortune, the ones that are mathematically impossible for him to make today. This is the cruel symmetry of investing. The strategies that create wealth at small scale become unusable at large scale. And yet people keep copying the wrong phase of success. They mimic the end game, not the beginning. If you're managing $5,000 or $50,000, your advantage isn't access to Wall Street research. It's access to places Wall Street ignores. You can go where the elephants can't. You can buy what they physically can't buy. And that difference between what they must ignore and what you can explore is your moat. But I'm not telling you this to encourage recklessness. Being small doesn't guarantee success. It only gives you room to move. You still need discipline, patience, and a refusal to lie to yourself. Small money is a superpower only if you know how to use it. And that begins with 3 simple rules. Rule 1. Know your circle. Stay within your circle of competence. That circle should be small, narrow, and constantly deepening. You don't have to know everything, just a few things you understand completely. Rule 2. Control the downside. In every small deal, your survival is the key variable. Avoid leverage you can't service, paperwork you don't understand, and people you don't trust. You can recover from missing an opportunity. You can't recover from ruin. Rule 3. Wait for catalysts. Time is not your enemy. Impatience is. Great small investments often look dead for months or years before the catalyst arrives. A sale, a restructuring, a new owner, a recovery in sentiment. The world eventually corrects obvious mispricings, but only for those still standing when it happens. Follow those 3 rules, and small capital becomes an extraordinary engine. Ignore them, and smallness turns into fragility. Now, let's talk about the guardrails, the boring, unglamorous realities that protect you from your own enthusiasm. Small markets are inefficient, yes, but they can also be illiquid. You might wait months to sell, and in the meantime, your paper profits are meaningless. Private deals come with legal traps, partnership agreements, hidden liabilities, tax quirks that can eat your returns. And information asymmetry cuts both ways. You might think you know more than the seller, when in fact the seller knows much more than you. So humility must travel with curiosity. Do your own verification, read every contract, and never let the words "too small to matter" make you lazy. The small world rewards diligence and punishes arrogance. When people ask me why I still talk about these things at 99, I tell them it's because the industry won't. They're too busy scaling, too busy collecting fees, too busy pretending that small investors can't win. But the arithmetic hasn't changed since 1963. Small amounts, intelligently deployed in places too tiny for the giants, can still produce returns that the big institutions can't even imagine. That's the silent truth no one on Wall Street wants to broadcast. The opportunities don't disappear as markets mature. They disappear as your capital grows. So, if you're small today, Don't apologize for it. Don't wait for some arbitrary number to make you feel ready. Start where you are, think independently, and look in places where nobody else is looking. Because being small isn't your limitation, it's your unfair edge. The first principle for investing small amounts profitably is what I call hunting where the elephants aren't. When you're small, you can go places that elephants can't. The giants of finance, the pension funds, the sovereign wealth funds, the endowments must operate in markets big enough to absorb billions. That constraint means they hunt in wide open plains where every blade of grass has already been trampled, analyzed, and priced to perfection. You, on the other hand, can slip quietly through the underbrush. In my early years, before computers and Bloomberg terminals, I spent weeks sitting in the public library reading through Moody's Industrial Manual, page by page. That book was a telephone directory of every publicly traded company in America. No charts, no color, no commentary, just raw numbers. Most of the names were tiny firms, forgotten by Wall Street because they were too small to matter. But buried inside those pages were occasional absurdities. Companies trading below the cash in their bank accounts, or with assets worth more than their entire market value. One of them manufactured parts for streetcars, a dying industry. The stock sold for $2 a share, and there were only 50,000 shares outstanding, meaning the entire company was worth $100,000. On its balance sheet, it held $120,000 in cash and securities, plus a factory building worth at least $50,000. You didn't need to be a genius to see the math. Buy the whole company for $100,000, sell the assets for $170,000, and walk away with a 70% gain in less than a year. Now, why didn't Goldman Sachs or Morgan Stanley scoop it up? Because $70,000 of profit couldn't justify a single analyst's salary. The elephants couldn't fit through the door. I made more than 20 such investments over the following years. Textile liquidations, holding company mispricings, tiny net stocks trading below liquidation value. Most of them worked exactly as expected. There was nothing mysterious about it. It was arithmetic, not genius. The inefficiency wasn't temporary. It was structural. It existed because nobody with serious money could be bothered to correct it. And that's what you should be looking for today. Places where prices stay wrong because the people with power and capital can't afford to fix them. You can still find these corners now. Micro-cap stocks with market values under $10 million. Local real estate parcels that are too small for developers. Small private companies owned by retiring founders. Specialized assets, licenses, royalties, patents, or collectibles that are too quirky for institutional investors. These niches are permanently inefficient, and inefficiency is the oxygen of extraordinary returns. But inefficiency alone isn't enough. You have to do the unglamorous work of reading, verifying, and understanding what you're buying. You have to go where nobody else is looking, and then stay there long enough for the math to play out. That's hunting where the elephants aren't. It's simple, but it isn't easy. You have to enjoy the quiet. The second principle is take massive swings when it's genuinely good. Most investors never do this. They nibble. They research for months, find one extraordinary opportunity, and then put 2% of their portfolio into it, because someone once told them diversification is safe. That's how you guarantee mediocrity. Nothing you do will ever matter. My grandfather taught me otherwise, long before I ever touched a stock. He was a farmer in Iowa in the late 1800s, a man of quiet intelligence who understood value instinctively. He worked the land, saved every dollar, and watched the neighboring farms like a hawk. He knew which soil was richest, which creeks provided water even in dry summers, which parcels would appreciate as the town expanded. Every decade or so, panic would strike. 1873, 1893, 1907. Banks would fail, credit would vanish, and desperate farmers would sell their land at 20 or 30 cents on the dollar. While others panicked, my grandfather acted. He would take his entire savings and buy one or two of the very best farms he knew, always adjacent to his own land, always within a circle of competence. He didn't buy 10 different properties to diversify. He bought the one or two he understood completely. Then he waited, sometimes 5 years, sometimes 10, until prosperity returned and land prices recovered. Over a lifetime, he made maybe a dozen major investments. That was enough to make him the richest man in the county. He didn't need hundreds of bets. He needed a few decisions of unmistakable quality, and the patience to let time vindicate them. That story shaped everything I believe about position sizing. When you find something truly exceptional, something you understand deeply, priced well below its value, with a margin of safety you can verify. You don't nibble, you swing. Of course, that doesn't mean blind faith or emotional betting. It means concentrated conviction built on hard evidence. You size your position so that a win matters and a loss doesn't destroy you. If you're wrong, you survive. If you're right, you change your financial life. I've met countless investors who pride themselves on owning 50 different stocks. They call it diversification. I call it diversification, spreading your ignorance so thin that even your right ideas can't move the needle. Real concentration isn't reckless, it's rational. The danger isn't in owning few positions, it's in not knowing what you own. The truth is, you only need a handful of genuinely good ideas in a lifetime, maybe 3 or 4 every decade. If you can recognize them, have the courage to bet meaningfully, and the discipline to hold through noise, you'll outperform almost everyone who mistakes motion for progress. So, when you encounter your equivalent of my grandfather's farmland or my early liquidation stocks, don't tiptoe. Step in with conviction. You're not rewarded for activity, you're rewarded for accuracy multiplied by weight. That's the mathematics of massive swings. The third principle is, don't fear a truly concentrated portfolio. Diversification has become a religion in modern finance. Every textbook, every advisor, every algorithm preaches it as gospel. Own 20 or 30 different stocks to be safe. What they don't tell you is that diversification was designed for institutions trying to preserve wealth, not individuals trying to build it. When you're managing billions, your goal is survival. When you're managing 10,000, your goal is freedom. The strategies are not the same. Let me tell you about a moment that changed the trajectory of Warren Buffett's career, and mine. It was 1964, during what became known as the Salad Oil Scandal. A subsidiary of American Express had been defrauded in a massive scheme involving oil storage tanks filled mostly with water. When the fraud surfaced, the company's stock collapsed nearly 40%. The market assumed bankruptcy was inevitable. Warren didn't assume anything. He went out and tested reality. He visited restaurants and asked managers, "Are people still using American Express cards to pay for dinner?" They were. He checked travel agencies. Were people still buying travelers' checks? They were. The scandal had crippled a small subsidiary, but the core brand, the profitable engine, was untouched. So, he made a decision that most professionals would call insane. He put 40% of his entire partnership's capital into American Express stock. Not 4%, 40. Within 2 years, the market realized its mistake. The stock rebounded dramatically, and that single bet transformed Buffett's fortune. If he'd followed conventional diversification rules, it would have been just another modest winner, quickly forgotten. Instead, it became a defining triumph, because he dared to concentrate when the odds were clear and everyone else was paralyzed by fear. Now, I'm not telling you to put half your savings into the first stock you like. I'm telling you that true safety doesn't come from numbers of holdings. It comes from depth of understanding. The same logic applies to real estate investor John Arrillaga. He spent 40 years buying properties within a 1-mile radius of Stanford University, nothing else. No geographic diversification, no sector rotation, just relentless focus. He knew every property, every owner, every zoning regulation, every traffic pattern in that tiny circle better than anyone alive. While others diversified themselves into mediocrity, he built a multi-billion-dollar fortune, one square block at a time. Both Buffett and Arrillaga prove the same principle. Concentration paired with competence is safer than diversification paired with ignorance. If you truly understand an opportunity, if you can explain it, defend it, and sleep at night owning it, you don't need 20 of them. You need a few great ones. Own patiently and size meaningfully. That's the paradox most investors never grasp. Spreading yourself thin doesn't protect you. It just guarantees that nothing you do will ever matter enough to make you free. True safety comes from deep understanding, not broad ignorance. So, when you hear advisors say, "Don't put all your eggs in one basket," remember what I've always said. It's fine to put your eggs in one basket. Just make sure you watch that basket very, very closely. The first principle for investing small amounts profitably is what I call hunting where the elephants aren't. When you're small, you can go places that the giants of finance can't even see. The pension funds, the endowments, the hedge funds, they have to operate in markets large enough to absorb billions of dollars. And that reality means they hunt in open plains where every inch of grass has already been trampled and priced to perfection. But when you're small, you can slip quietly through the underbrush. Back in my early days, before computers and terminals, I used to sit in the public library and read the Moody's Industrial Manual page by page. It listed every publicly traded company in America with nothing but raw numbers, and buried in those pages were absurdities, little businesses trading below their cash value, or companies worth less than the land they owned. One of them made streetcar parts, an industry everyone thought was dying. The stock was $2, and the entire company was worth $100,000. Yet on its balance sheet it had $120,000 in cash, and a factory worth another $50. You didn't need genius to see the math. Buy for $100, sell for $170, and make $70,000 in less than a year. Goldman Sachs didn't take it because $70,000 in profit couldn't pay for an analyst's lunch. The elephants couldn't fit through the door. I made more than 20 of these small investments, and most worked as expected. There was nothing magical about them. It was simple arithmetic that stayed profitable, because no one with serious capital could be bothered to correct the mispricing. That's the point. Inefficiency isn't rare, it's permanent, and it lives where big money can't go. If you're willing to do the boring work, to dig where others don't, that's where you find extraordinary returns. The second principle is take massive swings when it's genuinely good. Most investors nibble their whole lives. They find one great idea and put 2% into it because someone told them diversification is safe. That's how you guarantee mediocrity. My grandfather taught me something very different. He was a farmer in Iowa in the 1800s, and he knew his land, his neighbors, and the soil better than anyone. Every few decades, panic would strike, credit would dry up, and good farmers would be forced to sell their land for 20 cents on the dollar. While everyone else was panicking, he bought the best parcels, 1 or 2 farms next to his own, that he could manage personally and understand completely. Then he waited, sometimes 5 years, sometimes 10, until prosperity returned. He didn't diversify across counties. He bought what he knew and held it until the cycle turned. Over his lifetime, he made perhaps a dozen such major investments, and that was enough to make him the wealthiest man in his county. He didn't need hundreds of bets, just a few clear decisions made with patience and conviction. That lesson stuck with me. When you find something truly exceptional, something cheap, safe, and within your circle of competence, you swing. You don't nibble. You size the bet so that if you're right, it changes your life. And if you're wrong, you survive. That's not gambling, that's rationality. People think diversification protects them, but spreading yourself across 50 ideas you barely understand only guarantees that even your best ones won't matter. A few concentrated decisions, chosen with care, can outperform decades of busy trading. The third principle is don't fear a truly concentrated portfolio. Diversification is useful when your goal is to preserve wealth, but if you're small and your goal is to build it, you need focus, not diffusion. Let me give you an example. In 1964, during the Salad Oil scandal, a subsidiary of American Express was caught in a massive fraud. The stock crashed 40%. Everyone thought the company was finished. Warren didn't. He went out into the real world to restaurants and travel agencies and asked, "Are people still using the card? Are they still buying travelers' checks?" They were. The brand was untouched. So he put 40% of his entire partnership into American Express stock. Not 4%, 40. Within 2 years, the price recovered, and that single investment changed his entire career trajectory. If he'd listened to the textbooks about diversification, it would have been just another small win, soon forgotten. But concentrated conviction built on logic, that's what builds fortunes. True safety doesn't come from owning dozens of things you barely understand. It comes from understanding deeply the few things you own. The same principle guided John Arrillaga, a real estate investor who spent 40 years buying property within 1 mile of Stanford University. That's it. 1 mile. He knew every owner, every street, every regulation, every comparable sale. When the market fell, he bought. When it soared, he sold. He became a billionaire by knowing 1 square mile better than anyone else on earth. People called him undiversified. I call him rational. Concentration plus competence is safer than diversification plus ignorance. So here's how you put these principles into action. Step 1. Choose one narrow domain. Pick something small enough for you to master. Maybe it's small SaaS companies under 50 million in revenue, or student housing near a college, or retail businesses in your city. The narrower the field, the greater your odds of becoming the local expert. Step 2. Spend 12 months building expertise. Read everything, talk to everyone, collect your own data, build your own spreadsheet. Create what I call your modern Moody's. Most people want returns before they deserve them. They skip the work and chase shortcuts. The work is the edge. Step 3. Wait for one perfect opportunity. You'll know it when 3 conditions align. The mispricing is obvious. The catalyst is visible within 6 to 24 months, and the downside is limited. Don't rush. Idle cash isn't wasted. It's the ammunition of patience. Step 4. When the perfect setup appears, bet big. Your best idea should hold 25 to 35% of your capital. Your next best 10 to 15. And the rest should stay in cash or treasury bills. Don't average down blindly. Only add when the facts improve, not just the price. Before you act, write a 1-page decision memo stating your thesis, the catalyst, the risks, 3 ways you could be wrong, and when you'll reassess. Writing clarifies thinking. Step 5. Once you've invested, do nothing. Don't check prices every day. Don't panic when markets fluctuate. If you bought quality at a fair price, time is your ally. The compounding process needs stillness more than brilliance. To help yourself stay disciplined, keep 3 small reminders on your desk. The first is your sizing rule. Best idea 25 to 35%. Good idea 10 to 15, everything else cash. The second is your go or no-go checklist. Enterprise value below tangible assets. Price to earnings under 7. Net cash position. Visible catalyst. Limited downside and clear legal structure. The third is your decision journal. 1 page with your thesis, expected value, 3 ways to fail, trigger to exit, and review timeline. These tools might seem tedious, but they protect you from emotion and memory. They turn investing from a guessing contest into a repeatable process. If you follow these steps, focus narrowly, build real knowledge, wait for clarity, bet with conviction, and let time do the heavy lifting, you'll find that wealth creation is not about brilliance. It's about discipline. Small money grows not by copying the big players, but by doing the opposite of what they're forced to do. It's arithmetic, patience, and integrity working together over years. That's how you turn being small into your greatest advantage, and how you let compounding quietly do what it does best. Make you rich while you sleep. This patient waiting might take months, years, even a decade. The discipline to do nothing while your ideas mature is what separates the lucky from the truly wise. But patience isn't just a financial virtue, it's a philosophy of life. Over the years, I've realized that the same qualities that make a great investor also make a contented human being. Calm focus, emotional stability, and the ability to define what enough means before the world tries to define it for you. Investing well and living well both depend on 3 pillars: health, relationships, and time. Let's start with health, because without it, everything else collapses. People think discipline is an act of will, but willpower is a byproduct of energy. You can't be rational when you're exhausted. You can't be patient when your body is screaming for rest. And you can't think long term when every day feels like survival. I've seen brilliant people destroy their fortunes simply because they ran out of stamina. They made impulsive decisions not out of greed or fear, but out of fatigue. Your mind is part of your body. When the body falters, so does judgment. The best investment you'll ever make is in your own endurance. Sleep well, move daily, eat sanely, and protect your mind from the noise that drains it. A calm, energetic mind can wait for a decade. A restless, tired one can't wait for a week. The market rewards those who can think clearly when others are distracted, and you can't do that if you're running on fumes. I've spent a lifetime preaching rationality, but rationality is just clarity sustained by energy. You won't find many people who built fortunes by burning out early. The second pillar is relationships and environment. The older I get, the more convinced I am that your companions quietly sculpt your destiny. Surround yourself with people who chase status, and you'll live in a constant state of envy and comparison. But choose friends and partners who care about substance, who read, who build, who keep their word, and your life becomes saner by default. I've never seen a person think independently while drowning in social competition. The right environment reinforces good habits without requiring effort. If your circle treats patience as strength, you'll learn to wait. If your circle rewards noise, you'll mistake activity for intelligence. When I was young, I looked for people who were quick. Now, I look for people who are consistent. Slowness, depth, and steadiness. Those are the qualities that let you survive in both markets and relationships. The world is noisy enough. The people you keep close should quiet you, not agitate you. Choose friends who make you calmer, not richer. Collaborators who make you better, not busier. In the long run, peace of mind compounds faster than money. The third pillar is time, and the wisdom to know when you have enough of everything. The most underrated skill in the modern world is the ability to stop wanting more. Ambition is useful when you're climbing. It's poison when you're already high enough. I've met countless people who spent their whole lives chasing bigger numbers, yet couldn't name what they were chasing those numbers for. The truth is, the concept of enough is the final competitive advantage. If you don't know your point of enough, the world will decide it for you, and it will always move the goalposts. Wealth is not a finish line. It's a tool for buying time, freedom, and peace. When I say that I don't want to die rich, I mean it literally. The goal isn't to leave the biggest pile behind. It's to live in a way that makes the pile irrelevant. The pursuit of more for its own sake turns life into an endless scoreboard. The pursuit of enough turns it into a story you can finish with satisfaction. Time is the only currency you never get back, and unlike money, you can't compound it. You can only allocate it wisely. I see too many people trying to squeeze productivity out of every minute, yet wasting entire years chasing what doesn't matter. The real game isn't to get everything done, it's to make sure the few things you do are worth doing. Financial compounding works slowly at first, then suddenly. The same goes for life. Spend your years on what deepens you, not what distracts you. Every yes is a no to something else, so choose carefully. When you combine these three, health, relationships, and a sane relationship with time, the rest of life, including money, starts to make sense. You'll think clearer because you're not tired. You'll act rationally because you're surrounded by rational people. And you'll feel rich because you're no longer measuring yourself against infinity. Wealth without health is anxiety. Wealth without friends is emptiness. Wealth without enough is slavery. After 99 years of watching people build and lose fortunes, I can tell you this with complete certainty. The principles that make you rich are simpler than you think. And the principles that make you happy are even simpler. Keep your body strong, your circle small, and your desires reasonable. The rest will compound naturally. Few decisions, long patience, and a clear sense of enough. That's real wealth. The ones who build serious wealth follow the same pattern. The ones who stay poor do the exact opposite. After almost a century of watching people make and lose fortunes, I can tell you that real wealth isn't built by luck, intelligence, or timing. It's built by structure, patience, and a refusal to do stupid things. The winners play a simple, boring game. They hunt where the elephants aren't. They swing hard when they find something truly good. They don't fear concentration because they understand what they own, and they follow 5 deliberate steps. They choose one narrow domain. They build deep expertise. They wait for a perfect opportunity. They bet meaningfully. And then they sit still long enough for compounding to do the work. Everyone else tries to do the opposite. They chase every shiny opportunity. They diversify into mediocrity. They can't wait. They can't focus. And they can't stay calm when markets move. The difference between the rich and the restless isn't talent. It's temperament. You don't need hundreds of bets. You don't need to own everything. You just need a few great ideas that you truly understand, and the courage to bet enough for them to matter. Wealth isn't the product of constant motion. It's the product of a few decisions made in clarity and held through chaos. The hardest part isn't finding opportunity. It's ignoring 99% of what looks like opportunity, but isn't. That's the discipline almost nobody masters. As your capital grows, your strategy must evolve. There's a natural transition point, somewhere between $250,000 and $1 million, when you begin to lose your small investor's superpower. Once your pool of capital crosses that threshold, the math changes. You can no longer move quickly or discreetly through small markets. You start to disturb the very inefficiencies that once worked in your favor. That's the moment to begin shifting gears, reduce concentration, increase liquidity, and professionalize your process. When your stakes become life-changing, emotion becomes your greatest enemy. Structure protects you. So does having a clear plan for risk, taxation, and legal compliance. Big money isn't just more of the same. It's a different game altogether. It demands formality, records, contracts, advisors, and patience on a larger scale. The great tragedy is that most people never adapt. They either stay reckless when they should get structured, or they get cautious before they've earned the right to. If you take one lesson from me, let it be this. Success changes the game, and you must change with it. The strategy that made you rich won't necessarily keep you rich. When you're small, be aggressive. When you're large, be careful. When you're building, swing hard. When you're protecting, tighten the guardrails. There is wisdom in knowing when to shift from offense to defense. That transition is the bridge between being lucky and staying wealthy. And before we close, I want to make something very clear. This content is for education, not financial advice. Always do your own homework. Always verify. Always conduct independent diligence on legal, tax, and risk factors before you act. The world doesn't need more people blindly following someone else's conviction. It needs more people who think for themselves. Now, let me leave you with a few lines that have guided me for most of my life. Small is a superpower until you grow too big to use it. You win by being less wrong, not by being faster. Patience is the rarest edge left in finance. Few bets, deep work, long time. That's the entire playbook. Time compounds money. Character compounds decisions. Don't copy rich people. Copy what they did when they weren't. Being small is not your limitation. It's your unfair edge. If you want to turn what you've heard into action, I'll make it simple. Give yourself 1 week, 7 days to start behaving like an investor who respects compounding. On day 1, define your narrow domain and write down exactly why you chose it. On day 2, build your list of modern Moody's sources, the blogs, databases, and filings you'll study for the next 12 months. On day 3, start your own database of 20 potential opportunities inside that domain, companies, properties, or assets small enough for you to understand. On day 4, write down the criteria for a perfect opportunity, clear mispricing, visible catalyst, and limited downside. On day 5, design your position sizing rule. Decide what big bet means to you, 25, 40, or 50%, and under what conditions you'll use it. On day 6, create your no-check rule. Promise yourself 48 hours without peeking at prices after you invest. If you can't stand still for 2 days, you won't stand still for 2 years. And on day 7, write your patience plan. What does 6 months, 12 months, and 24 months of holding look like? What distractions will you ignore? What metrics will you monitor? Write it down, make it visible, and treat it as a contract with yourself. This 7-day challenge isn't about doing more. It's about learning how to do less but better. It's about replacing impulsive motion with deliberate practice. In 1 week, you can move from passive dreaming to structured thinking. In 1 year, you can move from scattered effort to mastery. The investors who last don't worship opportunity. They worship structure. They understand that systems beat emotions and that discipline beats intelligence. What you're building here isn't just a portfolio. It's a way of thinking that protects you from yourself. The moment you internalize that, you'll stop needing external reassurance. Markets can rise, fall, or freeze. You'll still know what to do, and more importantly, what not to do. So as we close, remember the paradox that started this entire conversation. Being small is the greatest advantage you'll ever have, and almost everyone wastes it trying to look big. Don't. Stay small long enough to learn deeply. Build your capital with precision, not with noise. And when the time comes to grow, do it slowly and intentionally, with structure as your safety net. I've lived long enough to know that wealth built on understanding lasts, and wealth built on excitement doesn't. The market will tempt you every day to be clever. Resist it. Be rational, be patient, and keep your circle of competence tight. In the end, the game rewards clarity, not speed. Now it's your turn. How much money do you have to invest right now? And which narrow domain will you commit to mastering in the next 12 months? Leave it in the comments below. And if you want to take this philosophy from theory to practice, follow along. Next week, I'll show you exactly how to turn these 5 steps into a living checklist, one you can use for the rest of your life. Because getting rich isn't about luck or genius. It's about being consistently less wrong, one rational decision at a time.